So what was your morning meeting like?
It is a little bit more downbeat. I think clients have found the idiosyncratic risk quite difficult to deal with, and also that they don't really see the sort of end of the story. There's no sort of deadline or timeline as to when the Beijing is sort of feeling that it's finished with dealing with the private sector. So I think the way we would look at it at the moment is that the biggest issue for the authorities is not only income inequality, but also the inflation rate in China. That is, to some extent now, is constraining them in easing policy, as you've seen with the reserve ratio cut, but also that it's running well above what the consumers are feeling comfortable with. They're beginning to save. So I think the focus with the education companies and to some extent with the antitrust measures is all to keep the inflation rate, a lid on the inflation rate.
Do you think, given that we've seen contagion now, not just when it comes to equities, but the renminbi, we saw yields jump up, we saw spreads also widen a bit. Do you think this is more just about adding a higher risk premium to Chinese markets, or at some point do we have to start factoring in a slower growth outlook?
Well, that's a very good question. I think it's, well, in two parts. I think what the authorities don't want to do is to start to undermine the sovereign rating or any views on the currency or the balance of payments, because this is, as I say, a sector risk and an inflation risk, and not one that has to do anything to do with the fiscal position or the FX reserve position of China. So to some extent, they wouldn't want to see any spillover onto those indicators. In terms of growth, I think growth is going to start to undershoot trends. So looking at towards the end of the year, you're going to be looking at 5.5% year-on-year GDP, well below the 6% markets are being used to. And I think they want to start to get some insurance policy. That's why they cut the reserve ratio, but didn't follow through on the LPR. So I think there's still easing policies in the pipeline. Looking at the China 10-year government bond yield, it's saying you haven't done enough yet. So I think that's a good gauge for investors to see the turn in the cycle.
You have a whole list here of how you take advantage of all of these things. And essentially what it is the best way to invest today in China is to start 100% in consumer stocks. You have a whole list here. Let's qualify consumer stocks.
Well, I think the reality is that what's happening in China on a bigger picture level is a massive transfer payment. They've got to keep the middle income and lower incomes feeling satisfied in terms of the price level in the economy. So essentially trying to curb excessive price rises in education or housing or possibly healthcare, and ensuring that the bulk of consumer items are affordable for people. The irony at the moment is that consumption numbers in China are likely to surprise on the upside. You've got a massive staycation that's going to happen in China this year. Remember, Chinese tourists pre-pandemic spent about 266 billion overseas. All of that money is going to get spent in the Chinese economy.
We haven't even seen that. It's been a year since reopening in China, and it's been really slow to recover.
It has. To some extent, that's been saved. This is the irony at the moment, that consumers have saved that surplus that they would have spent overseas. But I think the measures that may be being introduced by the authorities to say, look, we're going to keep these prices lower, might actually start to kick off some sort of form of summer spending, particularly now that most of the issues around the COVID-19 have to some extent been controlled in China.
In fact, we're now just flashing this one from one of the ministers in Malaysia. To your point, a lot of these places that benefit from Chinese tourism, they're going to miss their target. Australia just announced further lockdowns as well. Does this trade come at the expense of earnings in a lot of these other markets?
Well, unfortunately, it is. And I think you can already see in Thailand, to some extent Indonesia, even Malaysia, the growth is being pushed out to next year. And even in Europe, places like Greece, 83% of their overseas revenues come from tourism. So from many of the emerging markets, the fact that they didn't get China tourists or not getting the same mobility is going to be a massive drag on this year's growth. And again, probably the season's already over for them now.